This is what proper chart analysis looks like. You guys can see on my screen here, I have an example of what your screens will look like by the end of this video. So stick around. Okay guys, so on my screen here is GBP card on the 5 minutes. We are going to be trading the smart money concepts today, and let us dive in and see exactly what we have to start doing. I know normally you guys expect me to go on a higher time frame and start dropping down, and from the title of this video I did not say anything about top-down analysis. I don't do top-down analysis when it comes to smart money trading because I trade the flow of the market. I trade the the current liquidity, fair value gaps, and all of that stuff that is happening on the same time frame that I take my trades on. I look at what's happening there. I'm not a fan of top-down analysis, even when I was trading price action. So if you guys have been following my channel, you know that I'm not a fan of top-down analysis whatsoever. So let's get into this video, and the first thing we have to do is we have to look for liquidity. We have to look for where liquidity is at and where the market is at. Has it swept liquidity? Has it changed character? Has it broken structure? Is an order block? Is the order block valid? Then we can trade. So let's start off with the trend line, because first off, you can see some highs here, and my eyes just spotted these 3 taps, and when I see more than 2 taps, I know I have a trend line and I know I have liquidity. So this right here is a selling point for sellers trading price action. Price action sellers are normally trading off of this trend line. So the market makers already know that there's a lot of stop losses above this trend line. And also, if we come in after spotting our trend line, what can we see? We can also see that we have double bottoms here, and double bottom is liquidity. Double bottom is liquidity, and normally liquidity will be swept. And when liquidity is swept, the market changes character. The market pushes in the opposite direction. So now that the market makers are aware that there is a lot of buyers here putting their stop losses below this area, this is what it looks like. Buyers are here and their stop losses are below this area. Let's say here, maybe at this low or something. This is what their stop losses look like. Some of them, their stop losses are even tighter than this, like that, right? So if we have trades like this here, you know that people are aware, not just you. Everybody is aware that stop losses are down there, and when they have stop losses there, what they do is they send price, they push price lower to sweep and liquidate you out of your position. Then you take your orders and sell it to other people. Yeah. So now that your orders have been swept out, what else can you guys see? Liquidity has been taken here to the downside, which means price does not really have a lot to do. So after liquidity has been purged to the downside, price most likely starts reversing to the opposite direction, just like you guys can see here. There are 3 phases in the market. Let me align everything so that you guys can understand better. There are 3 phases in the market. We have the accumulation phase, which is consolidation. In other words, you can call this manipulation phase. Then we have the manipulation phase, which is this move here that entices traders thinking that the market has broken out. This now to price action traders is a breakout, and they obviously enter buy positions here to catch the trend to the upside. But the market makers or the smart money knows that, okay, since this is what buyers are doing, they'll push the price lower now, then begin the real move. So this is exactly what price looks like when trading. This is called the AMD: accumulation, manipulation, and distribution. These are the 3 phases of the market, right? So this here is support to price action traders. This is support, this is resistance right here. And guess what this is? To price action traders, guess what this is? This is a breakout. And when they enter here, put their stop losses, and they're aiming for higher highs, what happens is the market crashes down again, take their money, then eventually starts pushing down to the lower side. Now, with this information, what can you do with it? Look at price here. We have price accumulating here. It bounced off here once, bounced twice, bounced the 3rd time. Obviously, people have hopes and they know that they are still going to buy here because price has been bouncing here before. But now, unfortunately for them, this sweeps them out and puts us in a bullish momentum. Now, what we have to look for now is the change of character. We already identified our liquidity, and we see that, okay, we know that price has purged liquidity to the downside. There is a lot of liquidity to the upside, and I'll show you guys in a while. So, what is the change of character? Let's go there. The change of character is simply when the market is in a consistent downtrend, which means the market is breaking lows to the downside, but it maintains the highs, right? When the market is in a series of lower highs and lower lows, that is considered to be a downtrend. Then the second the market pushes up and takes out the highs, instead of taking out the lows, it takes out the high, then it puts out a new higher low, put out a higher high, then the market has changed character. So looking at this pattern that I just drew here, when or at what point did the market change character? Immediately. The first structure high that was taken out is the change of character. In other words, you can write it chalk for short, right? So when this happens, normally your order block resides somewhere here. You can pull that out, then you see that price retests there, and it continues its move to the upside. So this is where the market shifts its momentum from bearish to bullish. The market was crashing down, then now the market is skyrocketing to the upside. So let's use this information now, add it to what we have, and see what we can do with it. Now, where's our chart? Looking at this chart, let's look at structure. We have a low, we have a high, we have a low, internal low. This is called an internal low, internal high. Then we have a low that breached this one, which means this is our new structure low. Internal high, internal low, internal high again, internal low, which is now the liquidity part. Then the market puts out a high, then purges structure to the downside, broke and stopped everybody out of this trade, which means this is now our new structure high because this low took out the previous lows, right? So this is our new structure high, and the moment this high has been swept, it's putting us in a buying trade, right? It means that the market has shifted its momentum to the upside. Okay, let's delete all of this so I have a clear space to work with. Good. Now that we know that this is structure, this is our new high and this is our new low. Where is our chalk? The change of character is when this high has been swept, right? Because instead of the lows getting swept, the highs got swept instead. So this here, we will label this as chalk. Beautiful. Now that we have our chalk, where's our order block? The order block is the last push that took out structure, the last structure low that took out structure. Beautiful. Now we have this low here. It tried pushing, liquidated these other blocks here, filled out these gaps, tapped here, then failed to break the highs, which means this low was unable to do its job. Now guess what? This low came here, then pushed up to the upside, and here we have our order block. I'm not saying that you just go and look for the low that put out a new high and you consider that place as your order block. No, they are unique and there are specific guidelines, there are specific rules that you must apply when choosing your order blocks. If not, you're going to be having order blocks here and there, and you're going to take too many trades and you're going to lose a lot of money. So you need to have a checklist. You need to have rules that you follow, or specific factors that you put into consideration when choosing your order block. I have mine, and mine is very private, and I do not give that information out for free. I will not tell you what factors influence my order blocks or what makes my order blocks valid from the other ones, but I'll just go ahead and tell you guys that this here is my order block. There's a unique pattern, unique candlestick formation, and there's unique price movement that I look for when I'm looking at my order block, and I've seen it in this candle right here. So I'll draw this out. It's my order block. So this is my point of interest. I'm looking that if price should enter here, I should buy this market to the upside and ride with the trend. So you guys know the popular say, the trend is your friend. Well, the trend is your friend until it ends. When it ends, sorry. Anyways, we are in on this trend, and let's see where price goes from here. Now, to add to what we have, I want to tell you guys something, a very, very short something about liquidity, about fair value gaps and imbalances, which is the same thing basically. So this is a fair value gap. The fair value gap is simply a three candlestick formation where the low of the candle A does not align or does not touches the high of candle B. So this is candle A, this is candle B, and this is candle C, the third candle, which is this one, candle C. So this right here is a fair value gap. This is a gap. That is a gap because this low and this high did not come in contact with each other. If they overlapped each other, you understand? Candle B does not really have much to play here. It's candle A and candle C. If this low and this high overlapped each other, it's going to close the gap. But now that it did not, there is a gap there, which is referred to as fair value gap. Beautiful. Now that we know what fair value gaps are, you can watch my previous videos. I have a video detailing explaining what fair value gaps is, or you can hit it up on YouTube to understand better. This is a fair value gap right here. So a fair value gap, basically the market feels it, So these things act as bait. To me, personally, I see fair value gaps as bait. I don't look at it as the reason for price to bounce off this area. I'm looking at it as a reason for price to come back to this area to fill it. And now it is actually risky when you have a fair value gap close to your order block. Many people will say your order block must have a fair value gap, but to me it's the complete opposite, because fair value gaps are often filled, and price could fill this thing and overfill it in the sense that it clears out this order block here without even blinking. You understand? But instead, if we have an order block to the upside, let's say we have an order block somewhere up here, then we're buying here, we know that okay, price will eventually fill this order block, right? So we stand a chance of riding price up to the order block, then we get out, because you don't know to what extent price will fill this order block. Sometimes it just taps it and falls down, sometimes it sweeps it out. So I use order block as bait. something that attracts price. The what pushes price to me is the order block and structure. You feel me? You need to have the structure on point. You need to have a good order block. If you have those on point, then you can push price. Okay, you can push price to fill other fair value gaps above it or below it. You don't use other blocks. You don't use fair value gaps to push price. No, it attracts price. Now that we know exactly where we are trading, we know where we are buying, and so how do we buy this trade, and what do we target, or where do we, where do we put our stop losses? So entries will be at the opening of our order block, which is this last red candle before the up push. Then our stop loss will be just, one pip below the week, just to cover up for spreads in case the market wants to go all the way there. Then we aim for 2. You can go for 2%, right? Okay, guys, I had a call, so let's get back to this video. Now we are buying here, opening of this candle and the close and the low of this green candle, right? That's where the stop loss is at. We're aiming for 2R. I mean, you can personally aim for more. Normally, like I said, fair value gaps pull the market, so you can look for the nearest fair value gap and put your entries or your stop losses or your targets too. So let's say we can target this fair value gap here. There's a fair value gap here. I don't know if you guys can see it. This fair value gap here will get filled. I don't know when that is, but price will fill this gap. So you can put your targets right there. Price will go up there and fill it, right? But now that price is not retracing to tag us into this trade, we might even miss this trade. As soon as this gap here gets filled, this setup here is invalidated. Do not stay trading this. It could still work, but the chances of it working is very low. Why? Because the only reason that we wanted price to go up has been filled. So why should we be in the trade? So if you guys enjoyed this video, stick around. There's check my description for links. I have a Telegram channel there, and I'm going to post this setup. And if this trade retraces, I will take this trade and I'll post all recent developments on this trade in my Telegram. So be sure to join my free Telegram. The links is down below. If you're interested in my mentorship, my courses, or my material, you can also use the links down below to get to me and let's have a chat. I'll put you on. I'll see you guys in my next video. It's your boy Gislen. Ciao.